When trading call options, the delta is a crucial metric to consider as it indicates how much the price of the option is expected to move relative to a $1 change in the price of the underlying asset. Here's a breakdown of what delta means and what you should look for. Understanding delta. Delta ranges from 0 to 1 for call options. It can be negative for put options. A delta of 0.5 means the option price will move approximately 0.50 for every $1 move in the underlying stock. Delta also represents the probability that the option will expire in the money. For example, a delta of 0.5 suggests a 50% chance of expiring in the money. Choosing the right delta. The delta you choose depends on your trading strategy, risk tolerance, and market outlook. High delta 0.7 to 1.0. These are deep in the money ITM call options. They behave more like the underlying stock, moving almost dollar for dollar with the stock price. Use these if you are bullish and want a higher probability of profit, but are willing to pay a higher premium. Lower leverage compared to lower delta options. Medium delta 0.3 to 0.7. These are at the money, ATM, or slightly out of the money, OTM, call options. They offer a balance between risk and reward, with moderate sensitivity to the underlying stock price. Use these if you are moderately bullish and want a balance between cost and potential profit. Low delta, 0.1 to 0.3. These are far out of the money, OTM call options. They are cheaper, but have a lower probability of expiring in the money. Use these if you are highly bullish and want to take on more risk for potentially higher returns. High leverage. Key considerations. Risk tolerance. Higher delta options are less risky but more expensive, while lower delta options are cheaper but riskier. Time horizon. If you're trading with a short time horizon, delta becomes more important because the option's price will be more sensitive to changes in the underlying stock price. Volatility. In high volatility environments, lower delta options may be more attractive because they are cheaper and can benefit from large price swings. Delta and hedging. If you're using options to hedge a stock position, you might choose a delta close to 1, deep ITM, to closely mirror the stock's movements. For speculative trades, a lower delta might be more appropriate to maximize leverage. Delta changes over time. Delta is not static. It changes as the underlying stock price moves and as time passes due to gamma. As an option moves further ITM, its delta approaches 1. As it moves further OTM, its delta approaches 0. Summary. Conservative bullish. Look for deltas between 0.7 and 1.0 ITM calls. Moderate bullish. Look for deltas between 0.3 and 0.7 ATM or slightly OTM calls. Aggressive speculative. Look for deltas between 0.1 and 0.3 far OTM calls. Please like and subscribe for more tips.